Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Target stock so we can determine if it's a buy or a sell. Target operates over 1,900 large discount retail stores. The original name was Goodfellow Dry Goods. That was back in 1902. Then they changed it to Dayton's Dry Goods Company in 1903. Then in 1910 they changed it to Dayton Company. The first Target store opened in Roseville, Minnesota in 1962. The company is headquartered in Minneapolis, Minnesota, and was founded in 1902. Let's get started with the model. This is a large cap company, 73 billion market cap. They're trading at $158 a share, and they have 462 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in 2021, almost $8 billion. It dropped to $5 billion in 2022. Then it became negative in 2023. They're investing a lot back into their business, negative $1.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 2022 at $7 billion, dropping below $3 billion in 2023. The company has completed their 2023 fiscal year because their fiscal year ends January 31st. So they're currently working on 2024, if that makes sense. Revenue is the sales for the company, and that grows nicely each year from $78 billion to a whopping $109 billion. Here's their most recent income statement for the 3 months ending January 2023. And their revenue was $31 billion, up a little bit, about $370 million from the same period in 2022. Cost of revenue is $24 billion, because if you go to Target to buy food or to buy batteries, they have to pay for those products themselves, and the cost to them is $24 billion. Then they charge us $31 billion. Selling, general, and administrative costs, like marketing for those TV commercials, that's $5.7 billion. Depreciation and amortization, $600 million. So their operating income is $1.2 billion. They're in an industry that's notorious for really bad margins, really low margins, because they're in the business to sell lots and lots of products. If you go to a fine jewelry store, you may pay $10,000 for a diamond necklace, and it only cost the company maybe $1,000 to make. So they have huge margins, but they don't sell nearly as many products as a company like Target. They'll sell 10,000 necklaces for $199 each and make like $5 each. They spent $129 million of interest on their debt, $167 million of taxes. So their earnings are $876 million, down from $1.5 billion. Earnings per share are $1.90, down from $3.24. It looks like they buy back stock because they had 476 million shares outstanding in 2022. Now it's 460 million. Diluted is 463 million. So if all the convertible securities converted, they would have 463 million shares outstanding. They grew their dividend a lot, 20%, from 90 cents to $1.08. Let's look at the capital structure. 11 billion of equity, 19 billion of debt. They're 37% equity, 63% debt. Their net debt is 16.5 billion. So they have about 2.2 billion of cash on their balance sheet. They have a WACC of 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 110 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $99 billion. We divide that by 462 million shares. And we get a calculated stock price at $215. They're trading at $158, so they're trading at a 27% discount. It's a buy according to the model. Simply Wall Street is even further out than me. They're at $275 a share. They're saying the stock is 43% undervalued. 24 analysts priced this stock, and the average price target is 182. The low is 155, the high is 205. Another 32 analysts priced this stock, and the average price target is 183. They say the stock is 16% undervalued. This is where the stock has been trading the last 21 years. It broke through $50 a share for the first time in 2005. And then it took 14 years to double to $100. That was in mid-2019. In the beginning of 2020, it was at 135 at its peak. Then COVID hit and it dropped to about 85. And then the post-COVID surge brought it up to close to $300. It has come down about 50% since the peak. It's trading in between 150 and 175 for the past 12 months. They have outperformed the S&P 500. This stock is up 400% since 2002, S&P 500 280%. But at one point, they were up over 700%. They pay a really nice dividend, 2.75%. Their yield has grown a lot since 2018. It was 62 cents, now it's $1.08. And their payout ratio is 72%. Since they have negative free cash flow, we can't look at the dividend over free cash flow. There are 9 companies in the same industry as Target, and if Target has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend more in CapEx than any other company except Walmart, because Walmart's a giant. They have a pretty weak debt to equity ratio. For every dollar of equity, they have $1.70 of debt. Besides Big Lots, they pay the highest dividend, 2.7%. They have the worst free cash flow, but hopefully all the investments into CapEx lead to greater free cash flow in the future. They rank 3rd in market cap, much smaller than Walmart and Costco. Price to book a little worse than the median average. Their PE is between the median and average, and their price to sales is equal to the median, better than the average. And they generate tons of revenue, over $100 billion. And their 5-year annual revenue growth rate is equal to the median in this industry, better than the average. So to summarize, they've been around 121 years. There's a Target in every state and pretty much in all the big cities. They do have a good reputation, a good brand, so I think it's great for a long-term hold, and they pay a sweet dividend. I have them trading at a 27% discount. I rank their free cash flows 3 out of 10, their revenue 8 out of 10, and their ratio is 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to become a member, just click on the link in the description below. Thanks for watching.